Welcome to Vlogs of History After Hours. I'm your host, Darius Cousin, and if you're unfamiliar with my show or what I'm all about, I do encourage you to check out my channel. I do have a show about history. It's called Vlogs of History. There's a new episode every week, every Monday actually. And if you've missed this previous episode, you can check it out right here. I'll leave a link. Make sure you do because it's going to contain a lot of background information that's going to be very helpful in understanding this video and what we're talking about here. So here in Vlogs of History After Hours, we're talking about the Wall Street crash of 1929. Now, why am I talking about this? Well, this week in Vlogs of History, we've talked about the Roaring Twenties, the decade of economic prosperity, of optimism, of everything good in society. Well, all of that came to an end when the Wall Street crash of 1929 happened. Stocks crashed by a record high, and that pretty much stopped everything that the 20s had built. And that's what I want to talk about today in this Vlogs of History After Hours episode. So, the 20s. Well, from 1920 to 1929, everything was good. People were optimistic about the economy. People wanted to buy. There was a huge jump in consumerism. People were buying things left and right. With the the popularization of the radio. Well, people had a radio in their homes. And when you have radios, well, marketers took this opportunity and started producing radio ads to get people to buy more and more things. And what happened was the economy went up. People were buying stocks. And when you have a lot of people buying stocks, the stock traders and the traders, well, they can afford to actually put a higher price to the stock and still manage to get buyers because stocks were that much attractive. And also loans were very easy for the people because the economy was going high. People wanted to get into the stock market. People wanted to get into stocks and buy more stocks and have a bigger impact. And to have a bigger impact, you need more money. And not everybody had unlimited access to funds as we would all like. So what they did was they took loans, they bought stocks, the stock prices went up. They sold their stocks, they repaid the loans, got more loans, invested more, and everything. It was an upward spiral. That's usually what happens. But when that happens, that's called an economic bubble or a stock market bubble. And usually when you have a bubble crashes. The most recent one would be the 2008 crash. It was a housing bubble where the housing prices were overvaluated and they crashed. So that's what happened in 1929. The thing is, for example, if you take steel, there was a stock called US Steel. That stock's price was very high and it was very overvaluated. The thing is, it did not reflect the actual production of US Steel. It did not reflect the actual production of that industry. That industry actually in 1929 was declining steadily, but declining. The automobile industry was declining as well. There are various signs of industries declining in sales and in production while their stock prices kept going up. This created a sort of a gap between the real industry and the stock price that was overvaluated. And at one point, on October 24th, it was a Thursday, stock market started to crash just a little bit. And people were afraid. They were like, wait, what's going on? Panic started coming in. What's going on? Why are the stocks crashing? They shouldn't crash. We've been doing so well. This can't end, Because whenever things are doing well, nobody wants them to end. Nobody believes they're going to end. When you keep winning at the casino, for example, you never actually believe or you never want to believe that things are going to end. But that's often not reality. So when that happened on that Thursday, big important people, I won't name names because they're irrelevant here, but important people with a lot of money saw that and they were like, wait, this could actually cause something. This could cause maybe a recession. We have to stop this. And what they did was they invested a lot of money in the stock. They bought a lot of stocks that were crashing to push the price back up. Because what they were doing was they were saying, okay, look, we're so confident in the market. We're confident that things are going to do well that we're willing to invest millions to buy these stocks just to show how confident we were. And when you put in that much money into the stock market, prices tend to usually go up. And panic was reduced. Because in the stock market, usually what causes everything to go down is panic. When people start panicking with money especially, they pull out their money. And when they pull out their money, prices go down, making more people pull out their money and whatnot. So by doing that, they managed to actually halt that small crash, that small decline of October 24th, but it wasn't permanent. Over the weekend, news and uncertainty about the market were flooded with the news. Every newspaper had a headline about the market being bad, about the market being uncertain. And on Monday, because you don't trade on weekends, on Monday when the opening bell of the stocks started, when the stock trading day started, well, stocks crashed so much. In those 2 days, Monday and Tuesday, often called to as Black Monday and Black Tuesday, the stocks crashed at a record low. I mean, we're talking about a lot of percents here that they crashed. And they had a system for how you would know what stock is at which price. They had a ticker that would roll, that would send information like this, for example. But this being the 1920s, the technology was slow and somebody had to actually type what was going on. The thing was, so many stocks were decreasing at a such fast rate that the ticker was always late. It wasn't real time like we have today. There was no way to have it real time. Often you would have, during that day, often you would have to wait hours for the actual prices to be shown. And even then, by the time those prices came, well, the prices would be already much lower. And so people were uncertain. They didn't even know what prices the stocks were trading at. So obviously people wanted to sell. Obviously people started panicking and everybody sold everything they have, and prices just went down, and that crash literally just stopped everything the 20s had worked for, everything the 20s had built. People were no longer optimistic. People became pessimistic. People no longer wanted to buy because, well, nobody had money. Say you invest $10,000 and you find that in 2 days your $10,000 is now worth $5,000. That's like half of it gone. Half of your money gone. You're obviously gonna want to pull out, and you're gonna want to hold on to that 5,000 for dear life, and that's what a lot of people did. And because of that, well, that's what started the Great Depression, the Great Depression of the 1930s that lasted actually a whole decade. So you wouldn't think that a stock market crash like this would cause something this big, but it did. People didn't want to buy. People were pessimistic once again. The only thing that actually got people out of the Great Depression, well, one of the things, was the fact that war was coming. Governments started investing a lot of money in war technologies, and that pushed people to have work, that pushed people to have more jobs, and when you have more jobs, you can spend more. Spending more means producers are able to produce more because there's a demand for the product. They get money, they're able to pay people, creating more jobs, and so the economy starts building back slowly. But that took a whole decade. So just really let that sink in. I mean, we've had a decade of good things, a decade of the roaring 20s, and inevitably followed after a decade of sadness, a decade of depression. And that's what I wanted to share in this Vlogs of History After Hours episode. I found it really interesting how the society could have made a shift from everything positive to everything negative in such a short amount of time, with 2 days being one of the most important days in stock trading of the 20th century. I mean, even to this day, people still talk about those 2 days. People still talk about Black Monday and Black Tuesday as being one big important crash in the stock market. So it's very important. So if you've enjoyed this video, please leave a like, share it to a friend, and subscribe to be notified when the next episode comes out. Remember, these ones come out every single Wednesday. Also, my Vlogs of History main show comes out every single Monday, so make sure to check that out too. Once again, if you've missed this week's episode, I'll leave a link right here. Make sure you check it out. It does contain a lot of background information and a more general view and positive view of the Roaring 20s and what they were all about. With that being said, I'm your host, Darius Cosden. It's been an absolute pleasure, and I will see you all next week.